All right, everybody, welcome. Today we're having a special presentation on a topic you might be interested in, which is what the heck is happening to the real estate market, right? What does all this mean? And today we have Matt Steinmetz from Envoy Mortgage, who has all the answers and can see the future and is going to let us know what's going on and what we can do about it, right?
I mean, that sounds perfect. Thank you.
Yeah.
Okay, so you can see my screen with the globe, right?
Yes.
Thank you, thank you. Okay, so thanks for joining today. As he mentioned, I am Matt Steinmetz. I am with Envoy Mortgage. That's me on the screen there. You can scan that QR code as always to get to my links. And I will also put that info in the chat here in just a little bit. We are here today to explore current state of the housing market, understand the effects of recent tariffs, and discuss how we as real estate professionals can adopt and thrive in the evolving landscape, right? That sounds really good. So hopefully we can accomplish all that, and I'm sure that we can. Michael or whoever, if there's somebody monitoring the chat, just let me know if I need to stop and answer something. But we are going to start with an introduction to tariffs and real estate. So what are tariffs, right? Tariffs are taxes imposed on imported goods like lumber, steel, appliances, everything else that comes in from another country. These can increase the cost of goods for businesses and consumers in the United States. The tariffs are meant to basically create an even playing field between goods that are made in the United States and goods that are coming into the United States. And what that means is that could increase costs of things that we are used to paying for. So there is a connection between tariffs and inflation, and we care about inflation because that affects the amount of the dollar, the value of the dollar locally, globally, and of course how many dollars we need to buy a certain thing, right? So the connection to real estate has increased production costs for everything that we make and purchase, higher consumer prices, and supply chain disruption. Supply chain disruptions is a big way of saying things cost more to make, they cost more to ship, they cost more to deliver, all the workers that are working and handling on it. And sometimes that puts a strain on businesses that are in that assembly line of creation and delivery. Sometimes they can no longer perform those tasks, or somebody can no longer afford to pay for those tasks to be performed. So that is how it connects to everything that we do and why tariffs are considered inflationary in their basic nature. The impact on the housing market and real estate, right? As I mentioned, construction costs that can elevate home prices, that can affect affordability. And as prices rise, of course, everybody, including first-time home buyers, may find themselves priced out, leading to reduced demand and market volatility. So we're going to talk about first-time home buyers a little bit later. As Michael mentioned, we are going to touch on down payment assistance, and that is one way to overcome this objection or this hurdle, as we say. So let's look at California in the recent history, being March right now, or April, but last month, March. The housing market showcased a median home price of $884 and change. That's a pretty hefty home price, right? Especially for first-time buyers, which is a large segment of people who are purchasing in today's market. The sales activity raises questions about several trends. Despite the spring season, sales remain subdued. So if anybody wants to jump in, do you think that it seems a little muted right now, or sales a little slower than we expected? How does that feel to anybody out there right now?
This is your audience participation opportunity. Don't everybody blurt out something at once.
Well, okay. So I'll just let anybody chime in as we go if we want to. But from what I'm hearing, lot of people are saying, and the stats show that sales have been a little bit lackluster when everybody was hoping for a more robust spring season. However, with that said, the amount of listings has really increased. So even though the current median home price is up to 884, that reflects ongoing challenges. Putting the price point out of reach and hurdles for first-time buyers. We're still seeing activity in the marketplace. We're still seeing resilience from buyers, and therefore we still see stability in housing prices, and in fact expect further appreciation in the marketplace. So the affordability challenges, as I mentioned, for the first-time buyers, putting a newly purchased mid-tier home, including mortgage, taxes, and insurance, the payment nearly at $5,900 in March, which is a significant increase. $5,900, for those of you who don't know, being a principal, interest, taxes, and insurance, which we call a PITI. A $5,900 payment at minimum could require income of $11,880 to qualify, right? So that's roughly about $142,000 a year in income. So what happens if you don't make $142,000 a year, or you and your partner or spouse don't make combined $142,000 a year? You're not able to afford the median home in California. So depending on where you are in California, that could have a big impact on where you live or where you could afford to purchase. And of course, these statistics are without any other debt. So you make $142,000 without any other debt, you might be able to afford a median home in California. You start adding on some car payments, student loans, credit cards, all of a sudden your affordability becomes even more of a challenge. So keep that in mind as you're talking to potential customers. And if your market has homes that are at or above, 849, and you start talking to people and they're sharing income with you, you can start to gauge from them whether or not that's going to be a challenge. So let's talk about some more housing market changes that's fueled by the tariff. We have some broader inflation implications. So what happens when the US dollar loses value, right? We mentioned that tariffs are inflationary. Import prices rise, right? And a weaker dollar means foreign goods become more expensive. So now you have this even harder challenge. You have the tariffs that are increasing the prices of those imports. And then you also have a weakening dollar, meaning we need more dollars to pay for that. So it's kind of a double-edged sword there. So investors also, when they look at inflation and a weakening dollar, investors may demand higher returns on their investments, which means higher interest rates are needed to be able to entice investors to put their money into the market. So we're talking about inflation having implications and driving up interest rates because the dollar weakens, and we also need more dollars to buy the goods. So it's not a great place to be. What happens when the dollar loses value? As I mentioned, another layer of that is the buyer hesitation. Uncertainty from the buyers may lead to delayed decisions, right? We've seen that for, a while now, where buyers are not certain about where the economy is going, what home prices are going to do, what rates are going to do, and they just kind of put things on hold. They get stuck. And it's our job to help them get unstuck, right? From the seller's perspective, especially now that inventory is up higher, we're seeing more price concessions. If we were talking last fall, which I know many of us weren't, but if you would have heard my presentations last fall, you would have heard me saying that towards the end of the year, the amount of seller concessions was actually decreasing. It used to be 30 to 33 to 38% of every listing was doing price reductions and giving concessions. That started reducing to around the mid-20s as the end of the year approached into January, and then all of a sudden, spring market came, inventory went up, interest rates did not go down as many had hoped, and concessions started picking up again. And it's currently about 35 or so percent of every seller is doing concessions or price cuts. So that's pretty hefty. 1 in 3, basically, a little bit more than 1 in 3. So if you're a buyer, it's a great time. And if you're a seller, just understand that you may have to entice buyers to purchase. As we talked about those impacts on construction costs, so I just wanted to touch on some ripple effects there and just mention, because in the past I've mentioned that every 1% reduction in rates increases a buyer's buying power by 10%. But the flip side of that is true as well. Every 1% increase in rates can cut buying power by up to 10%. So if we're in the high sixes right now, and we go to, let's call it 7, and we go down to 6%, we can assume the buyer can afford 10% more in payments just because that interest rate went down. But that flip side is true. If rates go up to 8%, the buyer loses about 10% in their purchasing power. And I'm saying that because there is so much uncertainty right now that within the next 30, 60 days, rates could be at 6% or they could be at 8%. And we need to understand that and know what that means to a buyer's potential, and also for your sellers, for your listings, and being able to walk them through the environment that they might be facing, right? So if we start to see the tariffs continue and the value of the dollar decline and inflation going up, all those are signs that rates are going to go up. Now, on the flip side of that, if we see some help, and by help, it's twisted because I mean things like unemployment going up, that's going to help mortgage rates stay calm or potentially reduce. But that also means people are losing their jobs. So depending on where you are and who that affects, that could mean your buyers can no longer afford to buy. But the ones that continue to have employment will have a better time with interest rates and qualifying for a slightly higher payment or a slightly higher sales price. Sorry. So in addition to that, another impact on construction, not just the cost, but construction in general, when builders foresee slowdowns, they start to see inflation go up, they start to see the cost of materials go up and labor go up, they may slow down on building, right? The building starts might slow down, permits might slow down, they might slow down the completion of construction unless those homes are sold. And when they slow down, that means less inventory on the new construction side, which pushes buyers to resale. And that means more buyers going into resale, sucking up the inventory. Less inventory means more competition and higher home prices. So it seems to be, no matter what we talk about, we're talking about higher home prices, regardless if rates stay where they are or even tick up a little bit, just because, as I mentioned earlier, that resiliency of the buyer still exists out there. And if interest rates do continue to go up, we will potentially see less inventory anyways, because as we saw when interest rates went up in the recent years past, less sellers tend to put their house on the market because they don't want to pay those interest rates when they sell and go buy something new. So it's kind of like this intermingled, twisted, strange effect that we always seem to have a lack of supply against the amount of demand out there that we have from buyers. Okay. So let's talk about the current rate landscape here and the volatility that we have. And you know what? It's strange to say volatility, even though it seems very volatile, because rates go down, they go up, they go down, they go up, but it's been in the same kind of bandwidth for many months, like 6, 7, 8 months. It's kind of been between this 6.625 and 7.25 range. And honestly, that's expected to continue, at least for the next 60 days, right? if the Fed changes their mind and the Fed decides to start lowering interest rates, that might change things. But currently, they're not talking about that, right? Powell and Trump are going at it. They're going fisticuffs out there, regardless how you feel about either one of them. They don't agree on what needs to happen with the Fed funds rate. And currently, they have said the Fed funds rate, they plan to lower rates later this year, but not right now. And that creates the market that we're in, right? Buyers find favorable conditions, not because of interest rates, but because that we don't expect too much volatility, even though interest rates are much higher. We expect them to stay in that band for the short 60-day time cycle right now. But they have a lot of inventory and could ask for concessions. As we saw, over a third of people are getting concessions or giving concessions. So that competition is out there from the sellers to be enticed. The interest rates probably staying about where they're going to be at over the next 60 days. And for the buyers, of course, if they do complain, which they do, about the current interest rates, we are just going to continue saying, hey, if you can afford it, now is a great time to get in, because we all know that every 1% that the interest rates drops brings like 3 million buyers into the market, creating more demand, creating overbidding, creating multiple offers, competition, prices go up, and you're going to benefit from increased appreciation from that demand. And you got in early, you got in before that happened. Wasn't I a smart real estate agent to tell you to do that? Because now look at all this equity you have. Plus, your property taxes stay lower because you bought lower. Your closing costs and your down payment were lower because you bought lower. And now you can possibly just refinance and have that same payment that people are getting today, but you have the benefit of getting in before with the increased appreciation and lower costs on those other items that I just mentioned. So you can be the hero, right? Just give them the facts, give them the details and the data. And as long as they qualify and they're comfortable with the payment, it's a win-win. So the 30-year fixed rate, as I mentioned, we've been in this range, 6.6 to 7.2. Speculation suggests that range could be anywhere, as I mentioned before, 6% to 8% in the next month, depending on what happens with that volatility. But most people agree it's going to be in the same range that it's been in. And we'll just wait to see what the Federal Reserve does. But in the short term, nothing expected. Inflation rates, unemployment data, that will be the continual influencer on mortgage rates, investor sentiment, all of these things, and the tariffs are going to be the indicators that we continue to watch to see what mortgage rates are going to be doing. So I guess I spoke that a little fast, but that's the slide that goes there. Those are the impacting factors on what the borrowers are going to face. Okay, so let's go into the future a little bit more. The Fed, the Fannie Mae by the end of 2025 predicts rates will decrease to about 6.3, and Freddie Mac was a little bit lower than that. So again, smart time to buy because there's more inventory, more buyers will come out of the woodworks and create competition as rates go down. Long-term upside when rates eventually drop, you have the ability to potentially refinance into a lower rate, and you have the equity growth, right? So this is the window smart buyers are looking at. The market is more relaxed, prices are still negotiable, and the upside when rates fall could be huge. So help your clients see that vision and act now. Okay, so I wanted to ask if anybody wants to chime in, what segments, what type of people, what groups of people are, looking to buy right now? Who is the biggest buyers? I gave you a big hint earlier when I said what we're going to talk about was first-time buyers. So other than first-time buyers, who is out making the majority of purchases today? Anybody want to just take a stab at that?
Investors.
Investors, that's a huge one. Another one that I like to talk about, we just call them life events, right? So those are your deaths, your divorces, your job transfers, anything that has a big implication on a change of life events. So those are the biggest segments of people that we've seen out there purchasing homes for the last year, 2 years, and what we expect to continue into the near future. Because with interest rates where they are, you don't see a lot of move-up buyers just selling on the west side of town to go to the east side of town or vice versa. So with that in mind, right, you have the potential to negotiate on prices and credits, and there's more programs out today than ever, right? I've been doing this for a long time. Down payment assistance is rampant. There are so many options out there for down payment assistance, not even just for first-time buyers. There's buy downs, temporary, permanent buy downs we've talked about on this call in the past. There's buy before you sell programs, bridge loans for those people who do want to sell and buy something else. We talked about that before. And of course, investors have investor loans, DSCR loans that use the rents from the property to qualify, not their personal income. Makes it a lot easier for investors to purchase. Those are a big part of what we're doing today too. So every challenge, like we're in a challenging market, right? Every challenge presents an opportunity by staying informed and adaptable. That's us. We have to stay informed and adaptable. We have to inform and help our clients adapt and help them find the value in the current market. The value right now for investors is huge, right? Because they can get in with more loan options, and whether or not it cash flows or not, that may not be important to them. Some of them look for other reasons like equity or tax deductions or write-offs. And they know, smart investors know that as as rates go down, prices are going to increase. In fact, I was just having a conversation with some agents in the Alameda, Oakland market, and they were saying they're seeing a kind of an influx of people who purchased duplexes in 2020, 2021 that are looking to sell their duplexes now. In a short 3-4 year time frame, they're like, look, we've made our equity in it. We got what we wanted. We're going to flip these. We're going to get rid of them and get out now while getting out is good. And just so let's talk about who's buying those. They mentioned that a lot of people that are interested in buying these are your what are we calling those? When you're purchasing with your parents, right? Into a multifamily situation where you're living in one unit and your parents are living another. And instead of getting a house with an ADU or putting them in a senior care facility or something, maybe they're not at that part in their life. They are buying duplexes and living in one and putting their other family members in the other. Generational living, I guess, is what we can call that. So interesting changes, interesting dynamics where we're seeing investors have the opportunity to purchase and sell right now if they purchased a few years ago and have a good experience doing that, as well as the change in multi-generational living and who's purchasing those properties today. So keep that in mind as you're out talking to buyers and sellers if they're investors, and who you could target for those types of inventory. So we talked about strategies, we talked about which segments are purchasing today, and so leveraging that data, leveraging what we're talking about right now, like I just mentioned with the duplexes and investors and first-time buyers and who's buying, who's selling, and just sharing that information. That's a great strategy for you. It makes you look like the expert and be a very trustworthy go-to person for that information. Okay, so I want to move on to the down payment assistance portion, where I'm just going to go very high level, and just because there is so much information about down payment assistance, and I want you to definitely reach out to us with your questions, and we can handle each scenario, each individual scenario a little bit more delicately, because there are so many programs out there. And it's not just the state programs. I will mention the biggest state programs that we hear about are CalHAPA and GSFA, or Golden State Finance, right? Those are the biggest two state programs, but there are regional programs, there are county programs, and there are city programs that are out there. So don't feel, like you have to have all the information. You can refer that client to us. We will talk to them about their specific situation because, as we're going to talk about here, the requirements for those kind of guide us to which programs we're going to talk to them about. So generally speaking, no matter who you talk to, who you refer to us, we're going to recommend a 15-minute phone call. That's just where we start. I'm not going straight into, hey, let's get an application, because A, that can scare off the customers, and then B, it could be a waste of time for us and them. So we often just say, let's do a discovery call, or you'll hear us call it a disco call. And we just have a 15-minute conversation with them to try and get enough information to go deeper in a direction that is appealing to them and worthwhile. So first off, down payment assistance, not just for first-time homebuyers. You will often hear somebody ask about first-time homebuyer program, and then other people think down payment assistance is only available to first-time homebuyers. So first off, it's not. There are programs out there for anybody. Even if you own a home today, you can still apply for down payment assistance. When you hear people talk about first-time homebuyer programs, there is often the idea out there that there's something special, right? Well, the something special is access to certain down payment assistance programs that is only available to first-time homebuyers. But there's really nothing else. There's nothing out there that is going to be a significantly lower rate or cheaper prices or significantly lower closing costs simply because you're a first-time homebuyer. But there are programs that help you with those things. Most of the time, first-time homebuyers programs like down payment assistance can have attractive interest rates because they don't necessarily move as fast when Fannie Mae or Freddie Mac or FHA makes their rate adjustments. Down payment assistance programs can have a lag time, and if we catch that window, those interest rates can be more attractive. On the flip side, as you start layering products, a first, a second, a third loan on those down payment assistance programs, sometimes that can actually drive up the interest rate. And so while we will talk to just about every buyer out there about down payment assistance or closing cost help, if they do have their own funds available, it's not always the best option. So just know, if you start talking to somebody and you're like, hey, call Matt, he wants to talk to you about first-time homebuyer programs, and then you see that we're talking to them about not a first-time homebuyer program, that could be why, because we saw that they had some of their own funds and it was just more advantageous for them, and happy to discuss that with you and them on a call as well. Okay, loans versus grants, or gifts. Down payment assistance programs can come in a variety of ways. There can be down payment assistant loans, and that is just like any other loan. You're talking about, I'm giving you X amount of dollars, and there is an interest rate associated to it. Now, within that group, there's another subset. You could have deferred interest loans, or you could have loans that are due on a monthly basis, just like the first mortgage. So on the deferred interest loans, those could be something that's just like, we call it a silent second. It's just accruing simple interest on the back end. And when you refinance or sell down the road, they're going to tally up what you owe, and that comes out of the proceeds there, or is due at the time of refinancing. Otherwise, you're making that payment monthly along with your first mortgage, or in addition to your first mortgage. So then we move on to grants and gifts. These are what we would talk about. You hear free money, maybe, but a grant is something that's not paid back. And sometimes these could have stipulations to them. Sometimes you'll hear somebody promote a grant, but really they have to live in the property for 3 or 5 years as a principal residence. Otherwise, that becomes due and payable. Or a gift, again, just money that's being given to them if they meet certain requirements. So there are programs out there that if you work for a specific county, right? If you work for Solano County or Merced County or something like that, there are a bunch of them out there in California. So if you have a question, if you have a county worker, if their pay stub says they work for the county, they could possibly apply for this grant and get extra assistance that they do not have to pay back. Also, different employments, right? If you're a firefighter, if you work in law enforcement, if you work as a teacher or in the school district, in medical, if you're a nurse, forestry, if you work for the prison system, there's so many out there. So if you have a question about any type of grant program for employment related assistance, those are out there, and I'm happy to share information with you. But it's definitely along the lines of first responders and educators, as well as any law enforcement, like I mentioned, prison, and even state workers like forestry, as I mentioned. So reach out if you have any questions on that, but those would be your loans versus grants and gifts. And it's a very popular product to talk about, especially on social media. It gets the clicks, it gets the questions, and we get leads every week from these programs that people are working for a specific county or work in those types of employer with those employers. Excuse me, I'm losing my voice. Okay, requirements. So they do have, most down payment assistance have requirements for a pretty decent FICO. 660 or above gives you access to the most down payment assistance programs, but as you go down 20 points, you go down to 640. There's still programs available, 620. You have a couple programs available, 600. Maybe you have one program available, but we will talk to them about that. And again, talk to them and guide them as we talk. It guides us to the programs that we will continue to talk to them about. So basically, even if they're FHA or conventional or USDA, we will talk to them about what's available to them. We have a pretty handy tool that we can talk about. Hey, this person wants to buy in Sacramento County, what down payment assistance are available to them, and then we'll start matching them up based off of other requirements like FICO, or it could be income requirements as well. So each county or state might have an income requirement that they have to meet in order to even get the assistance. And then if they have another layer of income requirement in that, they actually get more benefit with, like, say, a cheaper mortgage insurance. So we have to walk through all of that with them and explain based off of the information that we get. So as I mentioned, many options exist for down payment assistance programs. If you talk to a buyer out there at an open house or out and about, and they just say, I am interested, I just don't have enough money for down payment, or I'm saving for 20% down, or anything like that, you should have a response to something like, hey, would it be all right if I connected you with a recommended lender over at Envoy Mortgage? They have a lot of options that they can talk to you about, and we can just see if something's a fit today. And if not, outline a game plan for the near term and get them on the right path, because most people that are waiting and trying to save something can't save fast enough as these prices go up or interest rates go up. And we don't want them to get discouraged based off of any headline news out there that's made to grab your attention, right? We want them to feel good and confident. We want to pre-approve them and get them emotionally invested by out looking at homes. Okay, so that is our goal, and hopefully you found that helpful. That's me again. Scan that code if you want to get to my links, and any questions I'm happy to answer, and I'll put my information in chat as well. Any questions I can help with?
This is your chance. They're so busy furiously taking notes, thinking deeply.
Yeah.
Matt,
Well,
thank you so much for your presentation. This is Colleen Wollo. I have a quick question. Are you seeing that there is any leniency in loans because of the market, because of the stock market and the overall markets being a little bit in turmoil because of the unknowing of the future and how this tariff is all going to lay out? Are you finding that the banks and the lenders or yourself, are you finding that things are tightened, or that the rules have changed a little bit in the last month? Thank you.
okay, so no. And I will say that historically speaking, as as the industry, mortgage rates go up and banks become more conservative. They don't like to get riskier as the economy gets worse, I guess is the way that goes. Now, as we've seen over the last 4, 5, 6 years anyways, there's been a whole slew of new programs being released. We call them non-QM. Non-QM has been around for more than a decade, but it's gained popularity in the last 5, 6 years for sure. And those are loans that don't go to your traditional banks. They don't go to your traditional Fannie Mae, Freddie Macs, or FHAs. They help a segment of the market that isn't served by those entities. And those would be your bank statement loans, your investor loans, as I mentioned, with the rental income. There are the I-10 loans. Those things, they get created to fill a void in the marketplace, right? So it could be that we start to see programs come out to help buyers that don't fit traditional loan if that becomes more difficult to happen. Anybody else?
Matt, this is Monica
I
Moscoso.
have
I
a
don't know if you can hear me.
Yes.
Yeah, thank you so much for taking care of my buyer. I sent my buyer to you and you're working with her already, so I appreciate that.
Of course, thank you for that. And if I may share, she shared them I think on Tuesday, and we got an application late last night, and we started reviewing it this morning. So we hope to have that pre-approved very soon.
Thank you.
Thank you.
I have a question, Matt.
Yes.
Hello, Matt. Yes. Let's say that I have 3 or 4 members of the family making enough money to qualify for $1 million home. Is there down payment assistance available to that many people?
I'll say yes. I've seen siblings use down payment assistance before to buy a house together. And I would say I have other concerns, like whether or not their combined income might put them out of the range for the household income limits. So one of the requirements some of the down payment programs have are household income. Other programs don't look at everybody in the household, but just for an example, if I wanted to buy with my wife and my son was living with me and he was working, and even though he's not on the loan but he's living in the household, they might include his income in the qualifications, and that might exclude us from the program. So depending on what we're looking for and what we're talking about, it could work. And again, my advice would be have them talk to us, and we will research which guidelines and which programs might work for them.
Yes. I'm thinking in terms of 4 earners. They all have jobs and earning their money. And given credit score, given the overall gross income, the DTI, et cetera, I'm thinking in terms of it would be ideal to be able to have down payment assistance to motivate them to get into a house.
Yeah, I would like to get those numbers and double check, because depending on where they live and which program we're going for, they might not, or they might qualify based off of all of their incomes. I'm not sure what their income looks like, but
Okay.
I'm not worried about the amount of borrowers, if that was your question.
That's correct. Thank you.
Yeah, and so I'll just add in there, some programs, I don't know if all those borrowers are going to live in the home. Some programs don't allow for what we call non-occupant borrowers. So that would be like, again, my family, if I was helping my son purchase a home, if I wasn't living in the home, some programs wouldn't let me go on the loan to help him qualify, and some will. So again, we just talk to them. We try and narrow down that conversation to help us dictate which programs might work.
Yes. Thank you very much.
Good questions. Anyone else?
Matt,
Matt,
quick question. Do you anticipate any increase in the short term or midterm for REO or defaults as a result of all this?
We are seeing a slight uptick right now. So I would just assume that if we start to see unemployment go up, naturally, you could assume that people might have issues making their payments. Now, with that said, post-pandemic, there's been a lot of changes with the amount of, I don't want to say leniency, but assistance or help that servicers and lenders are giving borrowers that are in trouble. But I do think that we will continue to see a slight increase in that.
Okay, thanks.
Hi, Matt. Real quick question. My name is Rio. I'm new in the industry, and I was wondering if there's anything like a brochure that I know there's different types of scenarios, but for me as a realtor, do you have any materials for me, like brochures that I can kind of dive into and use them on open houses?
Absolutely. I'm going to put my info in the chat right now. Feel free to message me and I can send you over some of that.
Excellent. Thank you.
And Rio, if you're looking for more assistance, you could also, if you message me, we could talk a little bit about a business plan or something.
Yeah, I'm sorry. Was that Michael?
Yes.
You got it. I'll do that. Thank you.
Yeah.
And Michael and I were talking earlier this week actually as well, because there should be, and I don't know exactly what's in there, but definitely check out Brevity Marketer, because there is stuff in there are items in there that are Envoy related as far as helping you market some programs.
Yeah. Sandra Sample has her hand up. Oh my gosh.
I know. Good morning, everybody, and thank you for this presentation, which has been awesome. I have a real quick question, and that is, are you seeing the amount of lender concessions to the borrower decreasing?
No, I feel like I'm seeing more. We're because of things like price reductions and using those concessions instead of giving $10,000 or $15,000 lower price. A lot of people are using those concessions to entice a borrower with a lender credit for permanent or temporary buy down. And I think that has helped push the amount of concessions up.
Okay, thank you. And what seems to be like the maximum percentage they will allow for concession, including if the seller is willing to pay the buyer's agent's fee?
Yeah, so each government-sponsored entity, GSE, so that's be your FHAs, your Freddie, your Fannies, even jumbo lenders, they all follow what we call IPC limits, which are interested party contributions. So they'll have limits, and they differ by product, and sometimes within the product, like unconventional, depends on the down payment amount. So that is a great question, depending on which product and person we're talking about. But just for example, it could be as little as 3% concessions up to 9% concessions. So we would have to be more, precise on who we're talking about, if that helps. I hate to skirt the issue completely, but that's the right answer.
And
I appreciate it. Thank you.
And Matt, isn't it possible that the lender might consider, let's say the seller was paying 2.5% or 3% to the buyer for the buyer's agent compensation, that's sometimes outside of the 3 to 9% limit, or always part of the same limit?
No, because that's considered a customary fee from the seller, so that would be fine. That's kind of like the transfer tax conversation as well, right? In a lot of areas, it's customary. So as long as it's a customary fee, that would be fine.
So in other words, like I think FHA is 6%, right, is the maximum, contribution. But if there was, let's just say 3% is what the buyer representation broker compensation agreement said for the buyer's agent, then the seller could pay 6% towards the loan plus 3% to cover the agent's compensation, correct?
Correct.
Thank you. Thanks a lot, Mike, for asking that.
We had
That's part of what I wanted to know.
Sandra.
Pardon?
We had to talk.
Okay. All right. You know how to reach me. You know where I live.
Uh, not since the restraining order, though. Remember, that's.
Oh, geez.
Any other questions?
Hi, I have a question. People on the loan, um, do they have to be on the deed?
Okay. So my long answer to that is if you're buying the home and you're the main borrower and it is your home, like principal residence or investment home, even the second home, you would be on the deed. If you are a non-occupant co-signer, you would have the option to be on the deed, on title. I've only seen that happen in very limited situations because if you're to think through that, I think you'd ask yourself, why would I put myself at risk on the loan and not have collateral to protect myself?
There's
So
also
you,
the middle question is, you have the loan, but you also have the contract, the purchase agreement, and then you have the deed. And as you
Yeah.
know, between those, sometimes there's movement.
If you're on the loan, you're on the contract.
Right. And if you're on the contract, you're on the loan.
on the,
Yeah, and in either situation, if one has to be removed, then we need an addendum to say, John and Jane, but we're going to remove Jane. I need an addendum saying Jane is no longer purchasing this home, and then I would remove her from my loan.
Right. But as a general rule, if you're on the contract, you're supposed to be on the loan.
Correct.
And if you're on the contract, you're supposed to be on the deed. Sandra has been very
I can
quiet.
only think of very limited circumstances where it would make sense to me to not be on the deed, and that would be I'm helping again, I always go back to my family, but I'm helping my son buy his first house, and I'm not worried about recouping my investment into it, and I'm there to help him anyways if I needed help with payments or something like that. I certainly wouldn't do that for anybody outside of my immediate family.
so means it's basically concern about the person on the loan's purpose, but for the lender, doesn't matter. There's no like rule for lender required to be on the deed, but it's more your own concern.
Is the other person we're talking about a marriage partner?
I don't know. I have a customer ask me this question. So I was like, you have to be on the deed. So I'm confused myself why she keep asking me this question.
Yeah, a lot of times people, read something or see something or hear something, and I think the best course of action is to have them talk to either myself or even an escrow officer or the county to understand the implications of what they're asking. So if they came to me and I would try and understand why they're doing that, I might go to my escrow officer and say, hey, what do you think about this? What's the implications of that? And then they might say, have an answer that would help justify why they should or wouldn't want to do that. Because oftentimes we don't think about the ripple effect, like what happens down the road, what happens if there's some sort of marriage, dissolution of the marriage, or no longer friends, or you're no longer lovers with that person. That you don't want to be involved in something like that. And sometimes culturally, there are certain cultures that pool funds and pool assets together. That can be another reason to do it, but what happens if there's a fallout? How do you exit that strategy properly? You want to make sure that the title to the property, the ownership to the property, the rights to the property are what you're expecting in the unforeseen instances that something should happen, because life's not perfect.
And if a couple, let's say, is married, wouldn't they both be on the loan, whether They wanted to or not?
So in California, we're a community property state. So if I'm buying a home without my wife, California sees that as our community property anyways, unless I have her sign an interspousal grant deed at closing, which says, I'm Matt's wife and I agree this is his sole and separate property signature, right? So if you did that, then it wouldn't be my wife's property. It would just be mine. But if you didn't, then the state sees it as community property.
And good.
But in that case, both of them on the loan or just one person on the loan,
It
or
could
it
still be
doesn't
one
matter?
person on the loan because maybe I've seen it both ways, but let's use the wife. A lot of times if a younger couple, all jokes aside, but women may have a better credit score at a younger age versus men. So, a young couple, maybe the woman, if she has a great income, could afford the house without the man. And you don't want them on there because that makes everything more difficult. He might have too low, let's say he has too low of a FICO or doesn't have income to actually offset the debts that he brings to the table. There are several reasons, and I'm poking fun at young men because I used to be one, but nonetheless, there are reasons why you would leave one person off. Another reason, a strategic reason aside from that would be that Fannie Mae and Freddie Mac and some investment loans have caps on how many properties you can own that have financing on them. So let's say you're acquiring properties and you and your spouse or you and your partner, you don't want to be capped out at just 10 properties that have financing on them. If you each buy 10, then you can have 20.
And Matt, also, isn't it also that you might want to hold it in trust or hold it in an LLC or different ways so the contract can be with a certain entity? And then, of course, the lender, you need to supplement enough that you can make the payments.
Yeah, absolutely. In fact, I got a contract yesterday that was written in a trust. I mean, the contract didn't have the client's name; it had the trust name on it, and I don't see that often. Usually, I see it in the client's names, but we hold title in the trust. So certainly, you could do it in a trust. You can do it in an LLC. Not so much on traditional financing for the LLC, but definitely on the non-QM products for investors. They do LLC purchases all the time. Good question.
Matt, I think these complex situations usually call into light that these people need expert opinions as well, right? It sounds like they need counsel from a professional like you, really, to go through their complex situation, give them the best financial advice for them, right?
Yeah, I think that a lot of what we do is tag teaming anyways, because sometimes you'll have a question about, hey, can we do this or that on the loan side? And as I'm talking to them, they want to talk to me about specific properties or areas or how much something's going to rent for or vacancy factors. And you might be an expert in that area, right? And I go, well, you need to talk to Michael on that and get back with him, or we loop you in back then. So we tag team a lot, and that's the beauty of it because that creates stickiness, and it shows even in the very beginning, like if we've never worked together, right? But we start that right away because we have that understanding. It makes it look like we have this flow, this efficiency and trust and professionalism.
It double enforces the trust because I'm saying you're great and you're saying I'm great, and people feel like they're getting the review they need.
Exactly. And I'm saying he'll have the answer for that, or she'll have the answer for that. And then you're saying, well, you need to ask Matt that because that's his area of expertise. So that is the beauty of the relationship and the partnership that, this is creating with Michael Devlin's team and Envoy, in order to create that synergy. It's been great.
Okay, I have a question regarding the young lady who asked about the title and two people being on the loan and only one on title. You made a statement that if one moved, now they're not together anymore or whatever, not married, but just maybe two people who bought a property together, they're both on the loan, that, as I understood it, you said you could remove one, the one that's now leaving from the loan. And if I heard that correctly, the person that is now to remain on the loan, would they have to requalify for that loan before you remove the second one?
100%.
Yeah. Just wanted to make sure that's clear. And also, there was a situation where you were talking about the husband and wife. Maybe the wife is on the loan and the husband may not be because of, situations that you gave. What about the situation where they are both on the loan, but only one is on the title? This is a community property state, like you said. And let's say the wife, for instance, and the husband are both on the loan and the wife dies. The husband is not on title because they didn't put him on title. And I don't know if this is a question you can answer or not, but because this is a community property state, would you consider him now the sole owner or whatever, that the property now goes to him?
Okay, so this is
A little more
I
complicated.
will answer this by saying everybody in the state of California that owns a home should have a trust,
I understand
because
that.
the
Mhm.
limit of probate is like $160 something thousand, and almost everybody in the state of California, if you own a home for a few years, has that in assets, and it should go in a trust to avoid probate. Because even if you're married, it will still have to go to probate, as I understand. And while it's probably 99.9% likely that as the spouse, you would be awarded the property, it's a hassle
Mhm.
and it costs you money. And when you're already emotionally distraught for losing your spouse and you have to deal with that, honestly, it just seems stupid. So
Well, Matt, probate appointments are running almost 2 years now. So you're in limbo for almost 2 years, just trying to figure out and get the house in your name, even though you're still responsible for paying the loan.
that's
So
right.
I totally agree with you. A trust does not replace a will does not replace a trust, but a lot of agents don't understand this. And we shouldn't be giving, you can, but we shouldn't give advice on this. But they need to have an attorney. They need to be properly represented on these areas of major concern.
And that was going to be my comment. So thank you for bringing that up, because I was going to say, just like we bounce each other off for tag teaming and becoming professional and efficient and synergy and all of that, we need other people, right? I have insurance people, escrow people that I like to work with. I'm sure you do too. I also have a great trust attorney that I refer out for all of this, because, and I was going to say, if you don't have one, I can give you one, but it is imperative, because these things happen. And when you're young and you're buying your first home, it's kind of like planning for retirement. You're like, oh, I'm gonna invest in my 401k later. Right now, I want that money for fun, right? Later comes pretty quick. And as we have all learned as we age, people have events in their life, and sometimes there's tragedies at a young age, and you don't want to just be caught off guard. So having a trust attorney that you can refer, along with a financial planner, life insurance, a lender, escrow, home insurance, repairs, contractors, you need a Rolodex of people so that people just come to you for the answers. And I'm happy to be a part of that Rolodex if you'd let me. I don't know if Rolodex is still a term, Michael.
What's that?
I don't know if Rolodex is still a term.
Well, let's just say that there's a segment who have no idea what you're talking about.
Yeah.
Like, all
Everybody else can Google it or chat GPT it. It's fine.
to rubber stamp something, what does that mean? What are you talking about?
Yeah.
And Rio wants your contact information, or my contact information, Rio, which is it that you want? I don't know. If you were invited to this, you probably have mine, but
Yeah, I found it. It was yours, Michael.
yeah, I put it like in everything and
Yeah, I found it. Thank you.
pester you with emails. Yes.
Well,
Cool.
congratulations to CC Cruz as well. I see we have a recently anointed real estate agent there. That's great.
Yes. We should talk also, CC. Again.
Again.
Again, yes. I'm serious. Right now, because getting a real estate license is like getting a fishing license, you know, the license doesn't catch fish. Right? We have fishing classes, you know, fishing coaching, fishing help. We have really good bait as well. Yeah. I'll stop with the fish analogy. Any other questions?
And if there's no other questions, does anybody want to share a hurdle or something that we can talk about as a group and maybe help everybody do a little bit better this weekend?
Life is smooth sailing for this group, so
That's awesome.
they're hurdleless. Anyhow, we've reached our appointed hour, and you know how rigorously time blocked all of our agents are, so they're
Oh yeah, I didn't realize we were at an hour. Thank you very much for having me and staying on. I appreciate the great question.
all right. Thank you very much for joining us, Matt. See you again soon. Goodbye, everybody. Have a great day.
See you, Mike.
Bye.
Thank you.
Thank you.
Thank you.